Hello, everybody, and a very, very warm welcome to our latest free to attend webcast. It really is a question of good morning, good afternoon, good evening, because we have attendees from right around the planet today, and we're delighted to welcome everybody to this latest free to join session. Okay. I'm joined today by some real experts in this field of understanding and managing and mitigating the risks when investing in receivables. And this is a question that I think is becoming of great interest as the interest in funding receivables gets a broader base, a broader solution. There are many ways that this can happen. Open account receivables continue to be an alternative, an important alternative class for a wide variety of investors. And there are many investment models, many familiar traditional investments to choose from. And recently, with technological advances and shifts in the regulation, new models have created alongside new channels. Investment, I think, in receivables finance began in the early 2000s, and I guess it sort of grew in the first few years, but really slipped away at the time of the financial crisis, but I think is really resurgent. So I think the receivables finance market now is very healthy. There's a lot of growth. Recovery has been rapid and significant, particularly being seen after the pandemic, and that's great news. However, there's at this stage relatively little penetration into this asset class, and I think there'll be plenty of opportunity, an opportunity for intermediaries to fund funders. So today, what we want to do is to talk about how that can happen, how it can work, understand the risks that are involved in that, controlling them and mitigating them. So I'm delighted to be joined by a panel today who will be able to discuss this with us in some good detail from all aspects of the equation. So first of all, I'd like to welcome Igor Zaks from Tensor. Hello, Igor, welcome.
Hello.
And basically, if anybody doesn't know Igor, then they've not been in the working capital finance world for very long. So Igor is an expert in working capital management with a lot of experience. I'm also delighted to be joined by Gideon Jones from Atradius. Welcome, Gideon. Again, expert particularly at looking at this aspect of funding from the risk government side, from the insurance perspective. Long experience in trade insurance and receivables finance insurance. And very welcome to that. And we're going to be joined very shortly by Mike Catterson from Blackstar Capital, who's just appearing on our screens now. Hello there, Mike. Very good to welcome you on board, and thanks for joining us. Yourself, just introduce very quickly from Blackstar Capital, securitization, structured finance, particular receivables finance. You're the expert in this. You've done this for many years. So between us, we've got a panel that really is able to discuss all aspects of the managing and mitigation of risks when investing in receivables. So welcome to the panel and welcome to our audience. As usual, you're welcome and we encourage you to ask questions. If during the course of the conversation those questions are pertinent to the topic that's being discussed, we'll try and deal with them there. If they're more general questions, we'll look to leave them towards the end. But that's enough of me creating an introduction. You've come to join us to listen to the experts. So I think what I'd like to do is Mike, once you've managed to get yourself settled in, is to say, let's start off this conversation by saying, if we are talking about the idea of investing in receivables, what are some of the mechanisms? I mentioned that it's, securitization started around the turn of the century, but there are obviously many and developing ways that this can happen. So perhaps you could just talk us through some of the mechanisms that are in place.
Yeah, okay. So hi, everybody.
as John said, yeah, I'm going to start off today by covering the various structures that we can use to invest in receivables, who can invest in them and how. And I think the best way to do that, I think, is just to go kind of in a historical order and kind of tell a story that brings us up to date today. So if we start with the invoice financing world's oldest profession, we've got factoring. Factor typically both buys invoices from a company and collects on their behalf. The end customer tends to pay directly to the factor, and as such, the company's customers typically become aware of the factoring, which used to be a problem because there was a kind of stigma associated with it. Factors were considered really like the lenders of last resort. So I guess you could say then along came invoice discounting. The difference here is that the company continued to collect its own invoices into its own accounts, and the financing was undisclosed to the customers. Costs were lower because the companies, weren't effectively outsourcing their credit and collections. But whereas factoring advance rates were high and generally fixed, and on the whole pool, invoice discounting is only available on a selected block of the receivables pool. What else? Advance rates could vary, and they could go lower. But if you only needed a simple, flexible, and cheaper solution, this was fine. Now today, the lines between those approaches of factoring and invoice discounting, those terms, have blurred a lot. Factors offer undisclosed facilities, selective facilities as well. And invoice discounters may require redirection to their own bank accounts in some cases, which is typical of factors. Both of them offer both recourse and non-recourse forms of financing. And in terms of directly investing in them, I think the majority of both are like 90% or so owned by banks. However, if you could invest directly in them, maybe through like an independent fintech invoice discounter, which we'll get to a little bit later, the key risks to the funding providers is very similar. There's the risk that the customers or the buyers can't pay. So, invoice discounters and factors have to perform a credit analysis on each customer. There's also the risk that the customers don't have to pay because of dilution. So in other words, if the company has incorrect pricing on an invoice, if there are shipping errors, damaged goods, it could be contractual stuff, discounts, warranties, promotions, rebates. So they have to review the company as well, or the supplier's business. And all this, as you can imagine, takes a considerable amount of time, going entity by entity for the assessment. So moving along in the history, alternatively, there sort of arose a new approach in trade receivable securitization. So with securitization, you analyze the risks on a receivables pool basis. And in a diversified granular pool, the chances of your 4 or 5 largest customers all defaulting at once is very small. If you do have concentrations, at the top, you can set a limit for them, which could be 2% for a non-rated obligor, or up to 100% if that obligor is rated at least as well as the note that you're issuing for that securitization. Dilution risk is assessed based on the historical pool performance, which updates all the time. There's a small yield risk on the notes, but receivables collect out fast, so in amortization, that's not a gigantic quantum of a reserve that you would need. And the rating agencies have issued trade receivables rating methodologies to follow for how those structures are set and how they do the rating equivalency of the notes that are issued to fund them. The drawback is that there's a critical mass required. When I was in 2005, when I was at Citibank, I don't think we'd even look at a deal or get out of bed for a deal, as we'd say, for anything less than 100 million and per jurisdiction, not total deal size. But setting the reserves for default, dilution, and yield based on updated monthly performance gave us higher advance rates, more accurate and dynamic advance rates. And best of all, back then, under the pre-2008 or so before pre-crisis capital requirements, the banks held little to no risk-weighted capital against these, as they were funded primarily through CP conduits, which meant that investors could get some exposure to trade receivables by investing in commercial paper, but not 100% just in trade receivables. You'd also have auto loans in there. you would have, you could have mortgages, you could have credit cards, you could have lots of other things, but some countries were majority, 60%, 70% trade AR. And so as I mentioned, the crisis there, that sort of brings us on to, either buying receivables originated on fintech platforms or joining a traditional or fintech-based receivables finance program. We can use the umbrella term supply chain finance more specifically here when we start talking about buyer side programs. But anyway, post the 2008 crisis, the word securitization became synonymous with just bad, right? Even though it was mortgages, it didn't matter. The approach that the regulators took to risk-weighted capital at banks was very sort of one size fits all, and suddenly it was no longer really economical to continue funding a lot of the same sorts of programs that they were before, given the amount of risk-weighted capital they'd have to hold against it. Essentially, all the SMEs lost out on that avenue to funding, going through securitization. Similarly though, at the same, or coincidentally at the same time, as the banks were getting out of offering that to SMEs, the banks had also been transitioning to more data-driven reporting requirements, and the technology firms were coming up, platform providers were coming up, offering, sort of originally, the way that we would have to look at a securitization deal would be on a monthly basis, but a lot can happen in that month that we'd have no insight to. So reporting agents came along, and they started getting data streams directly from the suppliers, from the originators of the receivables, and then they could actually do real time sort of, or at least daily reporting that the banks couldn't do. Bank reporting was just getting information from the company, after it had been scrubbed and cleaned by the company, let alone past, before it was, raw and behind a firewall. And they were getting that on a monthly basis, at most sometimes on every 2-week basis. And you had no visibility into what was happening in between them. Whereas these new platform providers could get, a direct feed every night from the company itself, and then do a daily report, and then combine all those daily reports to produce monthly reports. And then eventually they sort of realized, well, maybe we could do some of these sorts of programs ourselves if we could find funders. And so now we're finally going outside of banks and outside of to institutional investors, to insurance funds and asset managers, who coincidentally also don't have the same sort of capital requirements that they kind of have the pre-2008 capital requirements, and the SMEs don't have access to banks, so they're interested in these sorts of programs as well. I guess the other kind of fintech platform that have arose have been like marketplace type stuff, where platforms have been set up to try to bring together investors who want to invest in trade receivables and suppliers who want to sell their trade receivables. And moving on from there, then of course, then other platforms started setting up, going the other way, which could be thought of as reverse factoring, I suppose, and it's called that sometimes. But where instead of starting with the supplier and looking at lots of buyers, you start with the buyer, and then you basically sign up their supplier. So the risk there sort of reverses, where you have 100% default risk on the buyer, but then you're only going to concentrate on investment grade buyers for the most part. And then the supplier can get, you sort of secure their supply chain. The supplier gets the benefit of the credit, they're typically less credit worthy, but they can take advantage of getting the rates based on the default risk of that higher rated buyer. And so other platforms have been set up to do that. Now, a lot of those were, in the beginning, were very much bank funded, or sort of white labeled and provided to banks. So they would use somebody else's platform technology to do that. And sort of the further evolution of that finally, and where we're at today, is looking at actually bypassing. Because the problem with supply chain is you're still sort of getting information after it's coming out of, even if it's coming automatically, that it's better, but and it's more frequent, but it can still be coming. It's still coming, it's outside of the relationship directly between the supplier and the buyer. It's still coming out to that platform. And what embedded finance can sort of do is make it more efficient, where now you can imagine that instead you partner with someone who's doing the electronic invoicing, which is on the rise and is mandated to be rolled out in most jurisdictions. If you go straight, and if you can go straight in and invest in somebody who's going to partner with that e-invoicing platform, now you've got the data stream that's going directly between the suppliers and the buyers. And so, a lot of the things that you would have to do when signing up, suppliers to a buyer side supply chain finance program is a lot of the hassle there is going system by system, supplier by supplier, each of whom are going to have different systems, different configurations, or the same systems with different configurations, and onboarding them all into the program, and not knowing in advance whether they're necessarily eligible or not. Whereas if you go straight to the e-invoicing platform, then everything that's already been done for you. They've already been standardized. The information, the invoices that provided already have the required information that you need in the format you need in a homogeneous way. You can do pre-screening to figure out, what sort of dilution we have historically, because that's your main risk there. Then the 100%, there's 100% risk on the buyer, but assuming that's okay, you're looking at is the supplier getting paid, or are they doing things that mean they aren't supposed to get paid? And so you can look at that. You can look at that invoicing, that raw invoicing data, and figure out in advance who's eligible and who's not. Set limits. A lot of the KYC stuff is automatic. And at the end of the day, so you're getting data that's transmitted from behind a firewall. The data is already standardized. You can run eligibility criteria in advance to target it. You can analyze historic receivables performance in advance. Eligible suppliers can see the product offering in the relevant portal they already use. And there's a button to start the onboarding process, and you don't necessarily need to even have buyer involvement, though it can definitely help. And I guess then the future here would be the emerging distributed ledger-based platforms, sometimes called like blockchain finance or invoice tokenization, which is a great idea. It still has a long way to go. Probably a lot of things. There's a lot of people working on it. There's more companies than I thought were working on it when I was looking at it a little bit more yesterday. And some big names in there like IBM, Accenture, and other partners who are like with Apple and stuff, I think. But the basic idea there is that invoices are tokenized, so they get a unique ID code and metadata that distinguishes them. When you buy an invoice, you actually have it in your digital wallet. You actually have it in your digital wallet. You wouldn't need a complicated sales process to evidence ownership, or even an SPV to separate the sales process, because it's yours. The metadata chain can include all the invoice details, which makes it easy to slice and dice invoice pools for various investor appetites. Each invoice can have its own waterfall. And so with blockchain cryptocurrency payments, you could automatically apply those in real time as invoices are collected. Like I said, there's a long way to go with that. There's things that have been identified like anti-money laundering issues. Which cryptocurrencies would you settle in automatically, and which ones are stable? But yeah, there's probably a lot more. There's probably a lot more issues with that we don't even know of yet. The unknown unknowns.
Yeah, that's absolutely the case. So thank you for taking us through that sort of that timeline where we've seen that there's really been quite an extension of development, a broadening of the solutions, the nature of the solutions and their delivery, and the increasing role of technology to facilitate them. And that's both made sort of some things work better. It's also creating an environment where there are more questions, but particularly, as you say, more recently with blockchain as to how to make that interoperable, et cetera, et cetera. So I think that places us with a really good sort of backdrop of sort of where the industry has come from and what the motivations are for people when they are looking at investing in receivables. So maybe now we can perhaps move the focus of the conversation and perhaps, Igor, if I can get you to spend a few minutes addressing this, is actually saying, well, okay, looking at these product solutions, what are the types of risks that are actually involved? What actually are the ones that are really directly related to the structure of the models, to the way that the parties interact with each other, to the underlying receivables themselves? What are the sort of things that investors are going to have to look out for?
I will start with the basics, and the basics is that invoice is not like a bond, it's not like a promissory note. It is something that is a combination of a various risks. So you have a credit risk of the buyer, so for a risk they're not able to pay. You have a performance risk of supply, and that means that there will be a dilution, there will be some reason why buyer don't really need to pay. You have a fraud risk, so the fact, for example, invoice exists or was not sold twice or whatever happened, it's not there. And you have a service risk, because if, for example, whoever is doing collection is going bust, or not able to provide the service, then you have the invoices, but there is absolutely no process to do something there. And each of these risks exist. And if you look through the micro sort of discussion about the structures, different structures have assumptions about different results. So factoring was a heavy-handed sort of approach. When you have a lot of controls, you do collection yourself, and you try to mitigate all these risks. Invoice discounting assume that the seller of the goods is typically a relatively good quality company. And you don't really need to control, because you have reps and warranties. They say the invoice is valid, they have all the different things. And if these things are not true, you go back to them and you say, oh, you provided me these invoices, they're not valid, please pay us back. And if they're investment grade company, who cares? It's a perfectly good way of dealing with it. But if they are SME, if they are high risk company, that's a very, very different, because of course you can go to them, but they have no money. The next one that, again, Michael was speaking, securitization, again, historically was based on a one very, very simple assumption. And the simple assumption is that portfolio characteristics are stable over time. So, and again, if you have a large company and they do sales for 50 years and they have, broader similar customer base, and you look there and you look what were defaults, what were dilutions, what were different characteristics of this portfolio, you can relatively safely assume they're going to stay broader within the same parameters. So if you apply a stress testing and you say, okay, this guy's lost at 1 basis points of credit, and the highest one ever was 2 basis points, and we apply 5, we are very, very safe. We'll be definitely, an A1, P1 paper, and everything is okay. Again, that's sort of the historical assumptions. And then we go to the new technologies and new approaches. So what do we want to do? We want to get out of these limitations. We want to potentially go and invest in assets that were not previously financed. So we are saying about structure when neither buyer nor seller will be a particular high quality, because every structure historically was based on one of them being a high quality. So you either go a supply chain finance, and you broadly saying, okay, because we have a confirmation of buyers that is due to be paid, it's a buyer's risk. We don't care what is the risk of suppliers. So providing we put some basic controls to make sure, there is no fraud and other things, we have main reliance on the quality of the buyer. Or if we work on receivables, we have a high quality supply, and again, we are fine, because the risk of the buyers we can manage on a portfolio basis, and on a portfolio basis we know what to do, unlike individual, or we can wrap it, we put insurance, we put other solutions, and anything going outside of this, we go to supply and we are saying, yeah, you didn't meet representations that you made, so that was not a valid invoice. So if we start going into this sort of newer world, we really need to be careful how we manage the risk. And that means that we need to have the tools to assess the individual credit risk of the buyer. And again, there are many technology solutions now. In a new world, we can actually access, for example, their books. So we can look at the real-time information, not at the historical information that provides us more insight. We can look more in the granular data on the supplier side. We can look more into how do we construct the portfolio and how we control. And for sure, we can do a different type of enhancement. So we can put a backup service, and we can do other, we can use insurance, we can use many different ways to address it. But to me, we really need to focus on this risk and make sure that technology itself is not a panacea, it's just, additional view. And if you look at any technology, there is also sort of an assumption there. So for example, blockchain is a great tool. However, garbage in, garbage out. It's only as good as the right data in the right way are on the ledger. Because if you put wrong data there, they just sit there. So for example, if, like for example, is done in, say, Singapore on this platform, every invoice going through the platform, then for sure, if it is a record on a blockchain, it cannot be duplicated. And that's sort of, original sort of idea behind the blockchain, that you avoid duplication. But if you cannot put it on a blockchain, it can also sit outside of a blockchain or on a different blockchain, and they don't talk to each other, then you have no security, because you just have a record there, and somebody say, oh, but this invoice was not even there. This invoice was already sold, outside of the system. The same thing with things like artificial intelligence. You have machine learning. You can really do a lot by interrogating the data and put in various type of models there. But if the data are wrong, or the data are not cleaned and not prepared, and everybody who talk with who you talk in machine learning field will say 90 times of effort is always data cleaning. 90% of effort is how can you get the right data. So very often what happens, people apply technology, but the data are not suitable, and then you have the wrong one. So with all the technology, it's a great solution. You just need to very, very clearly identify the problem, and very, very clearly identify what risk you are trying to mitigate through these tools.
Okay, it's interesting that you say talking about, for example, interoperability of blockchains. I think the sort of ignorance and assumptions are risks in themselves, because people tend to assume that such things are bulletproof, but they're not, of course. I think that, again, just talking from my own experience, for many years operating in receivables finance, there are many risks that we would look at, and most of those you try to deal with through your systems and procedures. But the risk that always caused the loss of money, the actual, for things to go wrong, almost always came through fraud. That was always principally the source of it. So I think, for me, from personal pain, I always put fraud as the principal risk that we have to deal with in any of these solutions. And again, maybe my experience colors my view.
And one thing I will add here, risks are very highly correlated. So for example, when people have a trouble, financial trouble, credit trouble, that's where most of the fraud exists. So what you get the risk coming sort of in alignment, and all of them are interconnected. So for example, a supplier have a quality problem, the buyer is in trouble because they rely on it, their own processes are disturbed, and then one side or another start trying to create a fake invoices, whatever, to compensate for the loss there. So you suddenly get out of very low risk on all three, very high risk on all three, because one causes the other behavior. And like if you look at all the highest well-known fraud cases, most of them happen to be trying to hide an underlying financial trouble. So most of them was increasingly credit risk. So if you look at Android, at Parmalat, at a whole bunch of situations, and that's exactly where the fraud happens. So the problem is also this risk, they just come in a combination, And this combination is grown out of nothing very, very quickly, like out of experience.
Yes. Yes, absolutely, and again, I think that brings us to the first that fraud risk can really come from sort of two directions. Really, the sort of the credit-induced fraud risk, where people are under financial pressure and start bending the rules and start creating fresh air invoices because they know that things will correct themselves in due course, as they believe. And the out and out, the rogue, I can call them, that does everything they can to get behind your system simply to hoodwink you into paying the money for things that don't exist. But again, that's the bitter reality of it. But okay, let's not dwell on my pain. I think that I bring in Gideon here. I mean, Gideon, we've so far we've talked about the various structures, the various mechanisms that we can use to allow people to invest. Igor's brought to attention some of the basic risks that we can face when we're trying to operate in this environment. I'd like to turn to you to say, well, okay, we're not defenseless. What are the things that we can do? What are some of the ways that we can marshal our forces, use technology, use our intelligence to actually make this a safer environment, and an environment that actually we choose to operate in?
Yeah, sure. I mean, I think the first point is that any investor going into any type of asset class has got some basic human needs. They need to be made to feel secure, to be comfortable with what they're investing in, and very often, particularly as Mike said, as we've seen the evolution of who's getting involved in the investment in trade receivables, you've seen coming into the market investors who are actually no particular history or expertise in trade receivables, to an extent rather defenseless. If you think about earlier in Mike's timeline, the factor companies, they set up processes and systems and built in their own sort of like procedures to try and mitigate risk over time. The newer investors coming in need to have advisors who are going to help them understand what they're getting into and to lay down the right sort of structures which are going to help mitigate any risks associated with the investment in trade receivables. So fundamentally, I would split it into two, if I may. Firstly, when you're investing in trade receivables, you have the credit risk associated with all the obligors, all those people who are due to pay at the end of the day. And how you might mitigate against that? Well, firstly, in terms of whoever is managing day by day the receivables, they will have a credit team who hopefully will be manned with experts. These days, the industry, if I can call it that, of credit management is now quite highly evolved. You've got people like the Chartered Institute of Credit Management who provide training courses, best practice on how to manage portfolios of trade receivables. So typically, if you're investing in a portfolio which is of corporate trade receivables, you're going to have a credit management team there with skilled people who will be your first line of defense, because these will be the day-to-day servicer of the trade receivables. However, there's still another what-if question which you need to ask, which is, okay, the credit management team that normally looks after those trade receivables, they are looking after your assets for you, but what if they're not there? What if something cataclysmic happens and the normal servicer either dips heavily on their performance, so that actually what you're looking at in terms of data is a portfolio which is aging. In other words, the invoices are not being paid on time and are drifting, so that they're getting older and older. So you're going to pick this up from the data analytics that you're seeing. But if that's beginning to happen, or even worse, if the servicer gets into an insolvency event, then you've got a big problem, because trade receivables are incredibly dynamic. I mean, one of the good things is that they turn over very quickly, but one of the bad things is that if you don't attend to the management of the invoices, then they will really suffer from a lack of attention, if I can call it that in very general terms. So if the original servicing team is disrupted in any way, there's a big problem. That's why the concept of a backup servicer was created. So you see, particularly with securitizations, where the servicer is maybe not a AAA rated company, so there is some insolvency risk there, that they'll say, well, okay, we're going to get involved in this portfolio, but we're also going to appoint a backup servicer. And a backup servicer will, if it's a warm, hot backup service operation, will basically provide a data link so that they're getting hold of all of the invoice information, and that's refreshing on a daily or at least a weekly basis, which means that in the event that the servicer is not able to perform their standard duties, that the backup servicer can be activated. And what they will do is work on the invoice data and stand in the shoes of the normal servicer, send out a notification letter to all of the obligors who are due to pay, advising them which bank account to pay, and they will pick up a set of dunning processes as if they were the normal servicer. So that deals, if you like, or at least it gives a good protection to the servicer risk. And as I said, on the obligor risk, you can look at credit insurance. So credit insurance can be put in place on a portfolio, so that if any individual debtor does not perform, then a well set up credit insurance policy will ultimately enable you to put a claim in to receive reimbursement from the insurer as opposed to the original debtor. So I would say those two structures are very important here. And perhaps going back one step earlier in the process, the whole due diligence before you get involved in an investment is really critical. And I think both Mike and Igor have mentioned, the analytics that one can look at in terms of the historical performance of a trade receivable portfolio. Perhaps that's a little easier when you're investing in the invoices of a single individual corporate, because there's probably a track record there. You can sort of see historical trends. Where there are challenges maybe are when you're investing in the trade receivables, which are going to be generated by a newer startup or a platform where perhaps it isn't quite, it doesn't have a track record to look at. So you've got some more challenges in front of you there, because you can't really rely on the historic analysis there. Yeah, let me leave it at that for the moment.
Okay, fine, thank you. That's a good point for me just to remind the audience that, as mentioned, if you do have questions for our expert panel, do please feel free to launch questions, and we'll do our best to respond to them. Just one thing that occurs to me as we're talking about this is that, we are talking about how we manage and mitigate risks, but I would like just to try and put this a little bit in context, because one of the things I want to share is that, remind people that actually receivables finance and investing in receivables finance is inherently low risk. I did a pan-European study on this a couple of years back, right across Europe, with a very large sample of the European turnover from the receivables finance industry. And when you actually look at bad debt performance, write-offs performance, receivables finance losses were around about a quarter of those from traditional lending methods. So inherently, a much safer form of lending. So when we're talking about managing risks, we are talking about managing risk in an environment where we're actually in an operating zone where historically it has been very successful in terms of controlling those risks. And it's about sort of ensuring that we do that ever more effectively. And that for me is sort of a big lesson. So again, I put it back to you guys, and again, asking you to think pretty much on the hoof here, but you know, from your perspective, if you are in a position of advising somebody who is thinking about investing in receivables, what would be your advice to them?
I mean, to me, and that's what I do for a living. I advise quite a few people, you know, on it. Due diligence is a core, because you really need to understand. And the thing is, this is a bit different from, say, a traditional lender. So you really need to understand the underlying processes. You really need to understand, can you get a significant change in the profile happening without you noticing it, because that's very, very important. Are you able to comply with various things? So for example, Gideon spoke about credit insurance, great tool, but with a lot of requirements. What do you need to do to actually get yourself insured, to get your claims paid, whatever? If you just think you stick it on top of it and it's provide you a complete risk mitigation, that's not the case. You need to manage it, and you need to have multiple control mechanisms to make sure it's actually serving the purpose. If you get, you know, suppliers, you need to understand their business. You need to understand the business of the buyers. You need to understand how and what way these things are detected. And you either need to have a partner who is providing it, a platform that have all of this in place, or maybe some parts of it need to be outsourced and you need to get a separate control. So, for example, Gideon mentioned about backup services is very important. You also have things like invoice verification. You also, when you get a sample in, and there are people who provide it as a business, so they will take you a sample of invoices, you know, contact the buyers, and you don't really need to do it on every invoice like you do in factoring, but at least you get something. You need to have canaries in a coal mine. You need to have a number of mechanisms that will let you know about bad things happening before they happen, or maybe when they happen, but in a very small scale. Because, you know, if you get, you know, couple odd invoices being, you know, fraudulent, it's not a big deal. You lose like maybe, you know, a small amount of money. But if you miss this first sign, you suddenly see that everybody, you know, is running there, and you get the whole portfolio like this. So you really need to have, you know, multiple mechanisms how you do before you go to a deal. You need to have a monitoring mechanism. You need to have a good analytics on top of it. And if you have it, and don't rely on somebody else whose interests are not aligned with you to do it, because very often what happens, like look at the cases like what happened with the regional securitization, and similar cases happened with some funds recently. Oh, it's rated, so rating agencies look at this and they done it. Like if you look at the rating agency criteria in rating the funds, they're not very deep. So it's probably good to have it. It's, you know, a good addition, but you don't rely on it. You need to have like as an investor, you're safeguarding your money of your investors. You really need to make sure you have multiple controls being put in place, and then it's a very successful and a very low risk business. But if you don't have these controls and you don't understand the underlying reasons, what you can get, the things just slip. They just go there very, very quietly, and suddenly you find they're going to a scale that you can no longer control.
Yeah, yeah. I'd echo that one. I mean, what we see when we're providing the backup service solutions is very much sort of like a three-way partnership emerging over time. I mean, fundamentally, who is the beneficiary of a backup service would be the investors. They're the ones who basically put the money into the receivables, and if they don't pay out, then they want somebody to ensure that there's continuity. But in the end, you end up working with the seller as well, because the seller also is benefiting from the securitization program. They're getting cheaper funding, and they're putting themselves on a strong footing in terms of their future financing. So there is a little bit of mutuality. It doesn't sort of feel like you're fighting against each other. You're putting in a robust structure that the investors can believe in and gain sort of assurance from, but also from the seller and the beneficiary of the funding, that they're, if you like, by contributing to that structure, they're getting the benefit of cheaper funding, which improves liquidity. So there's a lot of pluses all sides if the thing is set up well.
Okay, thank you. Mike,
no, I mean, I agree with all that. I think data integrity is very key. Getting as close to the actual unalterable data as possible. I think I think in terms of due diligence, understanding, not looking at understanding that every program is different, understanding that if you're not dealing with a homogenized sort of standardized data stream, if you're dealing with individual suppliers to a bunch of buyers, or the other way around, one big buyer and a bunch of suppliers, understand that the systems that they use, just because the last deal that you've considered had this ERP and this was in this industry, it doesn't mean that their competitor with the exact same system is using it the same way, or that they haven't, or that they might even be considering things that they're reporting to you and the due diligence information they're providing you, they might be thinking about it a different way. So there's a lot of understanding that has to go into the due diligence, or the beginning process of understanding any sort of potential investment in that. And when backup servicing, I would agree that a hot backup servicer is a very good thing to have, and depending on, but there are many flavors. Gideon could talk to this more than I could, but there are many flavors between hot and there's many temperatures of warm, and it's important to understand when they say warm, what do they really mean by warm? Because like receivables turn over fast, that's good, so long as the receivables are still originating and going, and once there's a problem, if worst case scenario happens, and you have to collect that out, it's a bad thing that they're gone in 90 days or 120 days, if it's going to take you 30 days to get your backup servicer up and running. So what temperature, that warm backup servicer, I think is very important. And yes, of course, fraud, as you touched on, like all the big cases that you think about, Parmalat and what have you, are fraud covering up some underlying credit problem with that on the buyer side, or on the seller side. And going back to like the data integrity, one of the advantages, a big advantage of being able to leverage some of the new technologies that's coming out and stuff like e-invoicing, is that you're able to not just get like confirmation that the supplier has sent an invoice, the buyer has received it. You can also see that they've accepted it, and you can see the what changes they may have made in status of those invoices. And if you have APIs communicating between you have both sides, you basically have a confirmation. It's more difficult to have fraud with collusion and sort of on both sides, because you can detect those things a lot quicker if you're reconciling everything every day. You can if a supplier is falsifying invoices while you're they're gonna be sending them over and they're not gonna get paid, and you're gonna see that. Or if they've somehow figured out a way to falsify that payment, well, you're not gonna see it come in. If you can have control over your cash and control over your accounts, you're not gonna see that payment come in, and now there's a mismatch if you're keeping track of all of that balance. And at the very least, you know that it's a direct communication between, it's not like they're sending one invoice over here and a different invoice, as part of the information they're providing you for, to base the funding on. So yes, as Igor said, garbage in, garbage out. If you're putting, no matter how sophisticated the technology, if you're putting bad information in there, then it's going to come out bad. But at the very least, technology, the sort of the changes and advancements in technology that we're seeing, I think, are able to take out some of the human element that could purposefully make that information, corrupt or fraudulent.
Thank you.
One very particular type of fraud that is dangerous and difficult to prevent with technology is related party transactions, because it's really good if you have independent, you have buyer and you have seller, and you look at information. But if you have, like we saw in some recent cases, effectively, two entities controlled by the same people, showing you whatever picture you like to see, and and it will have a perfect track record because your money are recycled through the system all the time. The only problem when you try to withdraw this money, so when you actually try to collect, there is no money to pay you because you were the only source. And that's the type of fraud that is very difficult to detect just inside by looking at operational flow. So we really also need to do a lot of due diligence on the entities, and that process that is lacking in many cases.
Yeah, absolutely. I think there is a real sense that you have to understand the nature of the transaction. It's no good just looking at it as a stream of data. You have to understand the underlying transactions, excuse me, and the parties who are involved. But I think being close to the data is key. Trend analysis and using statistical tools, things like Benford's law, are really important in terms of monitoring and controlling. So I think that's a big point to make that you make there, Igor, in terms of we've got to keep a close eye on what is actually going on the ground, not just the information that we get.
I suppose there's one other thing one other dimension which we haven't mentioned at all here, which is, if you like, the internationality, the globalization of trade. Portfolios of trade receivables are not necessarily just one country domestic invoices. I mean, you can invest in those, but very typically it'll be cross-border, different jurisdictions, different languages, different time zones. So the structure to look after and manage those widely diverse geographic portfolios is another thing which needs to be picked up on the due diligence. Because all the way down the chain, you're going to need to have the resources in place to make sure that those invoices can be managed through carefully with assets potentially on the ground in multiple countries. So.
Yeah, I mean, both the local laws of the buyers and also, don't just assume that a receivable generated out of one jurisdiction necessarily has a sales contract that's governed by that law. There's plenty of large French automotive companies that no matter where they are in the world, it's French law. So yeah, there's at least two elements of law that you have to think about with regards to with regards to trying to. Again, these are very we're talking about a lot of risk involved in a very low risk, relatively low risk kind of investing, but there are many little risks.
Exactly, and it's about understanding what those are, and I think as we expected, time is whizzing past us. My colleague Eric has put up a question and sort of saying, really, there's probably a learning curve to go through for many newcomer investors in receivables. And what we're saying here is, from the participants of this session, the audience of this session, is there interest in taking part in further discussions, maybe an informal roundtable? We can try to formulate some guidance on that. So if people are interested in this, do contact us afterwards, and we can put something together on that. I've got one other question here, which has come up from an anonymous attendee. Hi guys, what's the dependency of securitization or fund structures of the portfolio manager's skills and deep knowledge of the receivable finance tools and risks? In what extent PM's dependency does become a risk itself? So I guess that's the human element question. We've been talking a lot about data. What about the skills of the people who are involved?
I think it's suicidal to invest in something that does not have either internal on a team or as advisors people with a deep experience in this area, because as I mentioned, it's a relatively low risk, but it's a low risk if you have a robust framework, and you cannot build a framework without understanding the underlying problems. So unless you know what type of things can go wrong, you cannot prevent them. And in this area, as I say, problems are rare, but when they go, they just mushroom. So unless you have either a fund manager who understands it, or they rely on advisors who have a good understanding, I think people are out of their mind investing in it.
Yeah. I mean, and the positive spin on that one, to respond directly to Igor's observation there, is that there are actually a good number of organizations setting up to support investors in this, where they're saying, okay, look, we are actually expert in the setup of trade receivable structures, and we can support you almost on a turnkey type basis in the setup, moving towards funding and ongoing running of the program. But yeah, I mean, I completely echo that. I mean, the stronger your team, whatever structures you're putting in place, but the stronger your team is, the more comfortable you're going to be as an investor.
Okay.
I'm not going to disagree with any of that. I'm not. Well, it would be like, no, the people managing these portfolios and setting them up, you don't even need them.
Okay, that's the thing. So with the strength of the team, and I think that's a great place for us to draw a line on today's conversation, because we've had a great strong team here discussing that. So Mike, Igor, Gideon, thank you so much for joining us today and sharing your expertise and knowledge. We really do appreciate it. So thank you on behalf of all of our audience. And to the audience, if you've enjoyed participating today, do let your network know, do tell people about these webinars, and do consider joining us here at WOA. We're an online organization, we're a low-cost organization and open to all. And I think that the more who join, I think the more we can bring these outstanding sessions to an audience, a wider audience. So again, I'd just like to say thank you to everybody for participating. It's been a real pleasure for me to have this conversation, and I'd like to thank everybody who's participated, and we'll look forward to more in the future. So guys, thank you very much indeed for your time, and I'll say goodbye to our audience. Okay. Bye. Goodbye, and thank you.
Bye.
Thank you.